Okay, chapter 6. We're going over fraud, internal control. We're gonna talk about cash. Have to have cash. You know, in the business, a lot of times we have businesses that have a lot of cash, some have hardly no cash. But we have to have internal controls over the money coming in, even if it's not cash, if it's checks. Why? Because there's fraud, and we have to put those internal controls in place in order to protect the organization from someone being able to commit fraud. We're gonna try to make that as hard as possible. Not that you can eliminate it altogether, but you want to try. So have y'all heard of internal control? No? Okay, so what do you think that means? Correct. So it's internal, right? So it's internal within our organization. How are we going to protect our assets inside of our organization? How are we going to have our employees accountable for what they're responsible for, right? So we want to protect the assets, ensure the reliability of the information. We don't want to have someone that's able to change things in the system. Think about an inventory that you have and somebody's got access to the computer and they can change inventory because maybe they want to take something and they've deleted it out of the system. So yeah, have some kind of internal controls, right? To figure out how we can determine, are these reports reliable? Is the information going to be reliable? And is it, you know, are our assets protected? How do we promote efficient operations? And how do we uphold company policies? So that's real big in an organization. We want to make sure that we have some things in place that people will be accountable. Okay, so have you heard of Sarbanes-Oxley Act? Has anybody heard of that? Or Enron? What happened with Enron? Has anybody heard about that? You heard about Enron? So what happens is organizations will be able to make adjustments, right, on their books. They can present their financial statements to users. It could be internal users, external users, investors. If anything in that flow of taking your information and getting it into the process of the system and producing financial statements, anywhere along those lines, you have fraud sometimes. Well, what does that do? That's saying that your financial statements are not accurate, they're not reliable, they're not useful, because the information that went in was tainted. And so that's what happens sometimes. So out of that process with organizations, there was a big, you know, I guess, scandal, whatever you want to call it. They had issues in the organization that were being done, that were improper, not following proper guidelines. And so they had an act come out of that. So as we go and things happen, we learn, and then we put things in place to try to fix those things. So Sarbanes-Oxley Act came about out of something like that. So it requires managers and auditors of companies who has stock that is traded on an exchange to document and verify internal controls. So what does that mean? They are able to have stock that's traded on an exchange. What does that mean? That's a publicly held company, right? So you have, you know, the stock market. You can buy stock. A lot of people have 401k. What are you doing with your 401k? Your money is invested in different stocks and different companies. So what happens is these companies have to now report their internal controls and their financial statements. There's all kind of guidelines that they have to follow and submit to someone that's going to review and see if everything looks like it's on the up and up, right? So those companies have to submit those paperworks, and they have to have a review. They have guidelines, they have dates that they have to be submitted. There's certain forms they have to submit by certain time frames. And that's all why? To protect the people that are investing in this company. I mean, you know, I have my 401k and I'm putting it out there and I'm looking at someone's financials, I'm looking at their stocks, I'm looking to see how things are doing, and things look great. So I want to invest over here. And if that information is not correct, well, then I've just made an investment and made a poor decision on information that's not reliable. We don't want that to happen. So this is a way to try to avoid that. So the Sarbanes-Oxley Act. Okay, so let's talk about the internal control for a minute. So the principles of internal control, I don't have all these listed out, but you may see them in the homework. I know that I have a few questions in there, so I want to just kind of read through some of this stuff so you're exposed to it. You see it on the homework. So the principles of internal control are established responsibilities. So we have different positions throughout the organization. We want to make sure that we've established who's responsible for what. Maintain adequate records. So there's going to be a process. You know, you hire for a particular job function, you should have a process that you're going to go through, and you're going to know how to record your transactions that you do, or whatever your job responsibility is. How are we going to adequately record that? Ensure that the assets and bond key employees. So make sure that, you know, you have some accountability in your position in your organization. Separate record keeping from custody of assets. So, for example, let's say I have a cashier that's receiving cash, and they are also the ones that are recording that they're receiving the cash and putting it in the system and bringing it to the bank. So you see how they're the ones taking it, they're the ones recording it, they're the ones bringing it to the bank. Well, where's the checks and balances in that to know, okay, somebody just took this in, who's checking to make sure that that cash is correct? Who's checking to make sure that it's entered into the system correctly? Who's checking to make sure that that money went to the bank? Right? Can happen on checks too. So there's lots of different ways to commit fraud with checks that come in, or checks through the payable process. So let's say I'm a payable person. I have access to the checks. I have access to payables modules in the system. I can put something in, I can cut those checks, and I can run them, and I can print the checks, enter the invoices, print the checks, and I can give them to my boss, or not. Maybe I can just fraudulently sign that check. There's no checks and balances to know, okay, I just put something in the system. Who was that invoice cut to? Maybe I made it out to my personal credit card company, and nobody looked at it. Nobody approved the invoice. So what happens? I just put something through the company, signed off on it, I fraudulently signed that check, and off it goes. So we want to make sure that we have a separate, you know, person that's doing these different functions, if you can. A lot of times you have small companies, and it's hard to have those checks and balances. And so then it really is relying on the people that you have, that they're trustworthy. But larger organizations will have a lot of internal controls. And these internal controls can be audited and will be audited in publicly held companies. Okay, then we divide responsibilities for related transactions, which we just kind of went through. Apply technology controls. So the technology controls could be, I have multiple users in my organization. They all have access to the same software, but maybe they don't have access to the same modules. Your function that you do is different from the next person next to you. So you have passwords, and the way that the management will set up those users is they'll select what do you have access to. So then you have controls over who's doing what in the computer, and one person might be limited to do this, another person's limited to do that. And the reason why they can do this function is because they're the ones that are overseeing this one. So you see how that works? You can have some controls, technology. What else are examples of maybe like technology controls? So think about something cool in like James Bond or something. What do we have? Think about like biometrics. Maybe there's certain departments that you can't go into, you're restricted. Certain people have authorization, some people don't, and they have biometrics. Maybe they have a card, maybe they have an eye scanner. Fingerprints, right, stuff like that. So that's another way we use technology to help protect our assets. Okay, and then we perform regular and independent reviews. So this isn't an auditing class, but I'll just mention that a lot of companies that choose to borrow money, maybe they're not a publicly held company, they're just a private held corporation that they have loans, maybe they have mortgages. So what happens with that? Sometimes those requirements from the bank is that you have to have audited financial statements. What does that mean? Somebody's going to come in, they're going to audit your books. They're looking at transactions. They're looking at all the internal controls. They're looking to see all these different things that go into the system, and they're going to test them some sort of way, all these different transactions. And so they'll come in and they'll do it, but there's not just an audit. There's a lot of different variations of that. So when we say review, sometimes we do have something called a review. It's not as extensive as an audit. Maybe we'll have a compilation, which is even less than a review. Somebody just comes in and they look at the information that's there and they prepare the financial statement. So just know when you, I don't know, for my accounting students, whoever's going to have to take auditing, they do have different levels of a review or audit. Okay, so technology allows quick access to information. So now, because we have technology the way we do, there's a lot of good in that, but there could be bad as well. There's a lot of transactions maybe that we're handling electronically. There's apps now to get into certain software. So you don't have to be behind the desk, behind the computer. Now you can have your tablet or you can have your phone. You can be off, you know, traveling to another city in a meeting, and then you can log in. You can still be in the meeting back at the office. You can still have access to all of your files. You can look into the software. There's a lot of things with technology now that make things easy and on the go and right at your fingertips. But there's some impacts to that. Could be positive, could be negative. So reduce processing errors. Would you think that's positive or negative? Positive. So now there's more controls to make sure that the information going into the software is accurate. So let's take example payables again. What does payables do? So accounts payable means I just bought something and I'm going to owe that vendor money in the future. I'm liable to pay in the future. It's accounts payable. So I have accounts payable clerk, and her job is to take the invoices and get those entered into the system. So she's key punching. She gets an invoice from the vendor. They have a date. They have a vendor number usually assigned in the system. There's usually some services or products that you purchased on the invoice. You put those in. Sometimes there's a purchase order you have to match to. A lot of different things go into that. So you're sitting at the computer and you're key punching. Well, what happens with advanced technologies? So now there's software out there that will work with your team, your invoices that come in, and with your software, and it'll grab those invoices and put them in automatically. So now you don't have someone key punching. Now you have someone reviewing. And so there's less chance of error because that information is going to be pulled right off the document into the system. Is it perfect? No. Why? Because sometimes things are hard to read. They might put a 6 instead of a 9 or whatever. So you have to review that stuff still, but it reduces the number of times you can make an error. So there's potential for that. A lot of the taxes, like our tax returns that we file into the system, the IRS has a scanner and just scan it automatically. Nobody even looks at it, just to let you know that. They'll match documents. They'll match the information you're putting on your return to information that came to you on those documents, W-2, 1099s. Those are all submitted to the IRS. So they have those in the system and they can match those up electronically. So it saves time on processing. So this could be an impact, could be a positive impact. So we have more extensive testing of records. We also can have new evidence of processing, separation of duties. So what happens when we enter information into the system? Let's say we all work for the same organization. We're all going to have our separate log on to the software. We're all going to have access to different modules. Maybe we have different job functions. So we're not all going to be doing the same thing. And so what happens is the system knows who's been logged in, who did this transaction. It's keeping like an audit trail, right? So it can go back. And now we have these advanced separation of duties and we have these advanced reports that we can get, and we can see who's been doing what in our system. Where have you been? Maybe you have a, do you have a scan tag when you go through different hospitals? So they can tell where you've been, right? So he walks in, he scans. And I know like when I went in for surgery, the guy that came and picked me up when he's leaving the room, he's scanning his tag. We get to the location where we were going for my surgery, he's scanning his tag. So he's being monitored how long it took him and where was he, what time was it when he went and got me, when he went and dropped me off. So there's all these different technologies that we're using to help keep track of what's going on in the organization. So we can have increased e-commerce. You know what e-commerce is? Online, being able to look at information online, purchase online. Well, what happens with that too? Now we have our information floating around and, the outer lands of the internet, our credit cards, things that we're buying, things that, maybe we have to put our personal information on documents that we're filling out for the doctor's office. So now we have all these things through technology. So now we can have increasing e-commerce. So I don't have to go to the store to buy. Now I can buy online. I can shop online. So that's definitely an impact as well. Then we have blockchain as control. So the blockchain says, viewed a new, more accurate type of accounting ledger, which is continuously and simultaneously updated and verified, makes it impossible for the ledger to be modified without a detailed record of changes. Records cannot be destroyed or hidden, as a record is shared and stored by multiple users. So what does all that mean? So basically it's just meaning that, now we can simultaneously be in the same software making updates to the accounts, to the system, to the tenant ledgers, to the payable ledgers, to the general ledger, making journal entries at the same time. And there's still going to be integrity in that information going in. It's all going to go in simultaneously, and the system's going to automatically update all that, and it's going to make sure everything's correct. All right. Let's move on to limitations to internal control. So we do have limitations because of some of the things we talked about already. We have human error. Sometimes we're just careless. Sometimes we, just transpose numbers. Sometimes we select the wrong vendor. We put the wrong amount. We put the wrong date. That happens. Usually there's always a fix for those kind of things, but we do have human error. We have, go back down. We have fraud. And so we talked a little bit about how that can come about. Someone sees a weak spot, and if they, have the inkling to do it, they're going to find a way to take money or commit fraud in some way that's going to benefit them. People do it all the time. I've worked for several organizations, and probably, let's say 3 out of the 4 places that I'm thinking of, we had someone that committed fraud. And so it happens. You wouldn't think, but it does. And sometimes it's multiple people, they colluding together. So that does happen in an organization. So in an accounting position, there's, as a CPA, you have to take ethics. And one of the reasons why is to keep you accountable. You're going to be around a lot of money or assets or ways that you have control over things that maybe, if you're not strong enough, could put you in a position to have an opportunity to commit fraud. And so that's something that's there, and that takes a certain person to not have that happen. So you always want to make sure that you try to, if you're in management, you try to minimize the opportunities that people are given, and so that you don't have that happen in your organization. Okay, control of cash. So we talked a little bit about that, person getting the money, depositing the money, putting it in the bank. So you want to have some controls over that. You don't want to just have one person doing that if you can. Have some sort of checks and balances when cash is coming in. It could also be deposits of checks. So we also have electronic funds that come through. And so sometimes there's some things that happen because now we accept electronic funds transfer. So I know you've heard of different ways that people try to get into the organizations, try to figure out how they can get a hold of your money. Maybe it's not somebody internal, maybe it's external. And you'll probably learn about this in other classes with like information systems, but they'll send you emails. Somebody on an email will pretend like they're your boss, and they'll say, you know, something to try to get you to give them information about a wire transfer, or what's the information to do a wire transfer. And it's all because they're trying to get something set up. Why? So they can take money out of the account. So that happens too. All right, so cash management. So how do we plan to have cash management? So we want to make sure that we plan the cash receipts, that they meet the cash payments when they're due. And then we also want to try to minimize when we maybe pay the money out. We maximize how many days do we have. If this vendor's not giving me a discount, then I want to wait the 30 days to push that money out. I don't want to just pay right away. So a lot of companies will do that. They will, you know, have some credit sales. They'll have some cash coming in. They maybe accept credit card and cash they can get right away. Credit card, you pay a little fee to be able to do that, but you're getting your money right away. If you sell it on credit, then you have terms. You have to wait for a particular amount of time. So let's talk about an accounts receivable position. So what happens in an accounts receivable position? We've sold something and we set up an accounts receivable. Why? Because we're going to receive that money later. And it's an account that's going to be listed with the customer's name or the tenant name, or however whatever business you're in, you'll have multiple accounts with those names on there. So maybe I'm the one that enters the deposits in the system. I want to make sure I enter those deposits right away when I get them, put them into the system. Why? Where's that money going? It's going into the general ledger and it's hitting my cash account, right? So my controller's managing cash. He's the cash management. He's got to look to see. He sees the bills that are coming through. He knows what's going to have to get paid out. So he's managing the cash flow. He's managing, where are we? What are we going to be able to pay these bills that are coming up? There's reports that you can run to look at to see where are we, what we're going to pay out. Where are we with our cash balance? How much do we have in the bank now? So you have a lot of different things that happen in order to manage this cash. Well, if you're not putting your deposits in as the accounts receivable, you're lacking on that, what happens? Well, now I don't have a good cash balance, right? The controller has no good cash balance to manage the cash. Then, you know, that delays me making payments and maybe missing out on discounts that possibly I could have took. Also, what else does it affect? So usually in accounts receivable, we have somebody that does collections. Why? Because not everybody's going to pay on time. Sometimes people pay late. And so you have to, maybe they didn't get their invoice. That's been happening a lot with the storm and with COVID and all this stuff going on. The mail's been really slow. We've had a lot of delays. Some people don't even get the mail. So you may have sent an invoice thinking somebody's got it to pay. They haven't received it. So what happens? We need a collections person to come in and look at the reports, make the phone calls. Why? So we can try to get the money in to keep the cash going. See how that works? So we're managing the cash from a lot of different aspects. So everybody's got a role in that. And so if the person making the deposits didn't post it in the system, then I don't know, okay, well, I have this receivable schedule. It's telling me all these customers that owe money, but they don't all owe the money. They just haven't posted yet to clear off because they didn't do their job function. So you want to make sure that all these things are happening and you can see how they're affected, right? So that's part of cash management. Okay, then we have, we talked about cash receipts, controllable cash payments. We kind of talked about all that. Let's talk about bank activities. So the bank activities, we have bank services, EFT, electronic funds transfer. So we talked a little bit about that. We can have funds go out electronically. We can also have funds come in electronically. So my company owns a lot of buildings that has tenants, office space or retail space, and they pay rent every month. And so we have different ways that they can get online and they can make those payments through these types of transactions. But they also have some tenants that want to just electronically transfer the money in every month. And so we'll give them documents and paperwork so they can do that. And so that money just comes in right away, right? Just comes right through the bank, and we have to look at the bank to see what are the activities happening daily, especially in the beginning of the month when you have rents coming in. So you can see where those monies are coming from, and you can get them posted in the system in a timely manner. So we have the electronic funds, not only through that EFT, but also through other ways now that people can pay online. You have that type of stuff happening. There's also services with banks that you can do. There's something called a Dropbox. So I don't know if you're familiar with that, but they can make payments and they can go to a Dropbox, which is held by the bank. The bank collects all those deposits instead of me going to a post office box and picking them up and writing a deposit out and putting them in the bank. It just goes to a box over at the bank. The bank takes them out, gives you a scan of everything, and it puts it right into the account. So when I get the information, it's already been deposited. There's lots of different ways to do your banking transactions. Then we have bank statements. So I'm sure most of you have a bank account, right? And so the bank account tells you what? Bank statement tells you what? When you look at it, what does it tell you?
Your balance, spending and purchases, and
what you purchased, what you spend the money on, also what deposits were coming in, were there any fees, what did you get interest because you're earning interest on your money? So withdrawals, if you went and took out some money, a withdrawal, checks that are clearing. So you have all of this that happens on the bank statement. The bank statement is going to give you a balance, like a beginning balance, and it's going to give you an ending balance. Well, in the bank statement, that doesn't always match what we have on the books. Sometimes it's timing. Sometimes things happen on our books that the bank didn't do, or there's an error. Sometimes it could be because something happened on the bank side that we didn't know about until we got the statement, so it's not on our books yet. So a lot of times you're not going to match exactly. So you're going to have to figure out a way to do a reconciliation process to balance those back, tie them in together. So look at the bank statement. What adjustments need to be made to that in order to get to my book balance? What's my book balance? What adjustments need to be made to get to my statement balance? And so we're going to walk through how to do that process. And then we have adjusting entries. So sometimes, not all the time, when we're going through the transactions, we may have to do an entry into the system. So if the bank statement comes in, it shows that I earned $100 of interest and I didn't have that on my books, I'm going to have to put that on my books in order for me to be able to reconcile. I'm going to have to do a journal entry to record that cash coming in of $100. So it'll be debit to cash $100. And then I have to record it as interest income. So it'll be my credit. Interest income for $100. So now I have it on my books and I can reconcile back. So sometimes I will have to do an adjusting entry. Okay. So we're going to go through that process later. We're also going to look at petty cash. So a lot of times businesses will have like a little small petty cash box for different reasons. Sometimes it's small, sometimes it's larger. It depends on the size of the organization. We'll walk through how to set up a petty cash box and how to do the transactions that you have to record through the month, or maybe at the end of the month. Okay. The cash over and short, we're going to walk through that too, because sometimes the cash that you have, if you have a, let's say you have a register, you work at a retail shop and you have a register and you're taking in cash through your little sales throughout the day. So at the end of the day, you have to go through and you have to count the money that's in there and look at your sales, see what your sales were. And sometimes they're not the same. Sometimes your sales are different than what your cash has. And we'll use an account called cash over short in order to be able to do the entry and record those over shortage. And then you can look and see and evaluate at the end of a period, how are we doing on the cash over short? Are we always short on cash? When were we short on cash? Who was the cashier? There's many different ways that we can keep track of that. So now you have different technology systems. You've got somebody checked in and you got to register. They're ringing people up, and every time they're on, what happens? The drawer is short. So then you know you might have a problem with that particular person. So let's look at an example. So this is an overage. So we have more in the cash box. So if a cash register's records show 550, but the count of cash, so the register is showing 550, that's how much I rang up in my sales. So since I rang that up as my sales, that's going to be my sales that I have to record on my books, because I had $550, let's say it's merchandise, worth of merchandise that I sold, and I want to put that on the books. I'm going to have to record that as my sale. Then I count the cash. And when I count the cash, the register shows $555. Somehow I didn't give enough change back, or somebody, you know, gave me $5 along the way, who knows. So I have 555 in the box, which is more than my sales. So I have to record the entry. Well, I have to put on the books how much cash is in there, so I can record all of it. I'm not going to leave that $5 off just because my sales were 550. So I'm going to record a debit to cash. That's my asset, my cash, $555. And then probably bring that to the bank. And then I'm going to have cash over short for that $5. It's going to be a credit, which is in the good. So if it's a credit, it's good. If it's a debit, it's bad. And then I have my sales for $550. Now let's look at the shortage. So now my cash is going to be short from my sales. So I have a cash register showing $625 in sales. So I know that's what I have to record as my sales. So my credit to sales is $625. It's telling me that's what I rang up. And then it says the count of cash in the drawer is 621. Somehow I'm short $4. Maybe somebody took it. Maybe I gave too much change back. So I have to be able to record that short. So I put it to the same account, but instead of as a credit, it's going to go as a debit. And then the debit to my cash is the actual cash that I have. I have $621. So that's how much I want to go into my cash account, because that's what I'm going to be bringing to the bank, right? It's going to match. So cash 621 as a debit, cash over short $4 as a debit. And then my sales, which is what I rang up for my sales, $625 as a credit. All right, so let's look at petty cash. So a lot of times you'll have situations where you'll need to give cash for different reasons, just little things. Sometimes things come, something called COD, which is cash on delivery. So maybe I'm getting a delivery, then I have to pay for it. I have to give the money, so I need some cash on hand. Maybe somebody has to go, they're in a maintenance truck and something needs to be repaired. Maybe the tire needs to be repaired and I need to have cash for that. Maybe it's something small they need to go to the store and pick up for me, so I'm going to give them cash. Maybe it's a car wash. So there's different reasons why I maybe would have to have cash on hand. And usually, like I said, it's small. So we have a petty cash fund that we're going to set up for $500. So how do I record that? Well, I'm going to be taking the cash out of my bank in order to put into the office. So I'll do an entry to remove that cash out of my cash account, and I'll debit it to petty cash. So petty cash is getting set up for $500. So I'm going to debit petty cash $500, and I'm crediting cash because I'm taking cash out the bank to do it. So I'm crediting cash for $500. So they're two separate accounts now. So I still have cash and cash in the bank. I moved 500, right, to a new account. So that's how we set it up. So now during the month or whatever period, we spend money. We spent $40 on office supplies, $30 on deliveries, $35 on miscellaneous items. So I have to do a journal entry to record that. And I want to put those on my books. How do we record an expense? We're going to debit, and we're going to list them all out. So now I have office supplies expense, $40, delivery expense, $30, cash, I missed one, miscellaneous expense, $35, and cash credit, $105. Why cash and not petty cash? Do you know?
Because you receive cash back in replacement of the petty cash handed out.
Correct. I'm going to have to go to the bank now and take the $105 cash out to replace and put back in the petty cash box. So petty cash, once we establish the fund, we're not going to touch the petty cash account unless we change the amounts in the petty cash. And you can do that. Maybe I decide I need $800 instead of $500. So I do another entry to debit $300 petty cash, credit cash $300, and now I have $800 sitting there. So I don't touch that account. So the next time I do anything is usually going to be, I turn in some sort of document that lists out what the expenses are. I give it to accounts payable. They'll put it in the system, code it to the correct expenses, and they'll cut a check. So that check's being cut off the bank, and they'll go to the bank and get the cash and come back with it. A lot of times that's the process of how it gets replenished, the petty cash reimbursement. Okay, but we're going back to the bank and we're taking the cash out and we're going to put it back in our box. And so that's why we're crediting cash. Okay, so this was on the PowerPoint. I thought that this could be useful. You're going to be doing bank reconciliations. And so this listed things out that would help you know, okay, when this happens, where does it go? Is it something I'm reconciling back to my bank statement? Is it something I'm reconciling back to my book? So I thought this would be something good for you to review when you're doing the homework. So we're going to go over one, but it basically is telling you on this left in the blue that you have a cash balance per the bank. And what adjustments do I need to make in order to get me down to reconcile with my books? And then the right side is, here's my cash in my books. What type of adjustments need to happen in order for me to balance back to what that adjusting balance is on my bank side? So we have deposits in transit. What does that mean? Well, sometimes I have a deposit that came in, I brought it that day, and then the statement comes and it's not on the bank statement because I made it after 3 o'clock. So I know that the money's already gone in the bank and I recorded it on that day. Maybe it's October 31st. I recorded it that day. But by the time I made it to the bank with the checks, it was after 3. So when my bank statement comes, those deposits aren't going to be listed. So in order for me to tie back to what I have on my books, I have to add those deposits in. So I'm not doing anything on the books. I'm just saying, okay, here's my bank balance, and I'm going to add the deposits that I know are in transit, meaning that they're there, they're just not recorded yet. So that doesn't require an adjusting entry, but I do have to use that in order to be able to reconcile. Then I have outstanding checks. So maybe I cut a few checks today and sent them out in the mail, but those aren't on the bank statement yet either. Why? Well, because they haven't been received in cash, but I know the money has already left because I've already sent those checks. So I have to do an adjustment to deduct my bank balance to reflect that. So I don't know if you keep track of your own little register, but if you have a balance in your bank and you send a check out, you should write it down and deduct it from your balance, because you don't want to spend that money because you already sent that check out. You got to have the money in the bank to clear it. Hopefully y'all all know that, right? I don't want to bounce checks. So I need to deduct that from the balance. I don't have to do anything on my books. And then if there's any bank errors, depending on what it is, it could be something that I have to add or subtract. I have it correct on my books, but the bank had an error. And so I need to put that information on that in order to come back to my good book balance. And then I have an adjusted cash balance, which should equal my adjusted cash balance after I make the adjustments to my books. So what kind of adjustments can we have on the books? Sometimes on the books, we'll have to do a journal entry to record interest, which we talked about a little bit ago. Maybe I had something that was collected that went into the bank and I didn't record it on my books. Somehow I missed it. So now I got to put that on the books. So I have to do adjusting entry, but I have to add it in order to be able to match my bank statement because it's on my bank statement. So maybe there's a $500 deposit that hit and I didn't record it on my books. Well, I'm not going to match unless I get it on the books to reflect that balance. Then sometimes I have to deduct bank fees and NSF fees. Sometimes there's book errors as well. Maybe I made the deposit for $10.20 and it went in the bank and it was like, no, that wasn't $10.20, it was $10.26. So I got to add $6 on my books because the bank added $6 on their side. I haven't done it yet, so I got to do it on my books. So you see how this works? Why you would have to make an adjustment on the books, and sometimes you would just use it to adjust the balance the bank has. Okay, in the end, they should both equal. So I thought this would be something good that you can look at, and it would help you when you're doing the bank statement. I also wanted to just show a quick little example of a bank statement. So it just has the statement date at the top, who the bank is, your company name, and then it just lists out a total like of, has your opening balance. It has a total of what your total checks and debits are, what your total deposits were, and what your ending balance is. So this calls it current balance. A lot of times it'll call it ending balance. Or balance as of, let's say it's January. The start will have balance as of 1/1, balance of January 31. Okay, so it's going to give you both the beginning, a total of what happened for your deposits and what happened for your withdrawals, and then it'll give you a balance at the end. Then it'll list all the detail out. So I'm sure a lot of you have already looked at a bank statement, but that's kind of what it's going to look like. Same thing that your personal bank account looks like. You'll have all the detail listed under that. And that's what you'll use to go through your books and just match them up. It's a process. In the software, it makes it a lot easier because you usually have a banking module. And when you have the banking module pop up, you'll put what that ending balance is. The beginning balance is going to be the ending balance from the previous month that comes over. And then you'll put, okay, here's my ending balance now. And then you're going to take your statement that has your list of details. And then on your screen, you're going to have a list of details of what's in your system. And then as you go through, whatever your process is, whether you're checking it off on the bank statement as you're checking them off in the system, a lot of times you have to click those off to say, okay, these cleared, this one cleared. Whether it's deposits or withdrawals, any kind of journal entry you did, it's going to come through the banking system. So you just match it. Check, 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 check. Then you'll get to, okay, well, I see this deposit on the bank statement, but I don't see it on my books. Why is that? So that's how you'll do it in the system. Okay, and then you'll see, oh, okay, here I have this amount, but this has this amount. I have to do an adjustment to fix that. In the end, when they reconcile, it'll close it off. You can reconcile it, and then it closes it off, and then you're ready for the next month, and it takes that ending balance and brings it to the beginning balance. So it's a real simple process in the system. Softwares are different, but a lot of times they're doing the same exact thing. All right, and here's our formula for today. Days sales uncollected. So this is going to indicate how much time is likely to pass before we receive the cash receipts from the credit sales. So how long is it going to take us to collect? This is how we would calculate that. So we take the accounts receivable balance divided by the sales, the net sales, that's less your discounts and your returns, times 365, and that gives you your days sales uncollected. And you'll have a couple of those in the homework to go over how to do that formula. All right, so let's look at a couple of problems. Let me get out of that. I don't think it's going to let me. So I'm going to go back this way. So we're going to look at 5 and 7. So some of the questions are just going through some of the information we went over in the beginning of the night. And then you'll have some bank statements to do with your adjustments and adjusting entries and petty cash. So what do y'all think about this chapter? It's not as bad as the others. It's a little better. Okay. All right, so number 5. Make sure this is the right one. Let me see. I think I had another one that had something else. Maybe 7. That's the bank statement. All right, let's go back to 5. All right, so this company establishes a petty cash fund. It's going to be $490. They funded it on September 9. On September 30th, so now we've gone through the period of 1 month, almost 1 month, and we had some things that we used the cash for. So on September 30th, we show that we have $251. And the receipts for the expenditures show that I spent $50 on transportation in, $65 on postage expense, and $120 on miscellaneous expense. So the petty cashier could not account for a $4 shortage in the fund. The company uses the perpetual inventory system and then to count for the merchandise. So we want to prepare the established petty cash fund. We want to do the journal entry for that. And then on the 30th, we want to do the reimbursement of the petty cash. And then we decide we want to increase it from $491 to $525. So we're going to do that entry as well. So here's my petty cash fund to set up. So I'm taking that money out of cash and I'm setting up the petty cash fund. So the entry on September 9 is to debit petty cash $490 and credit cash $490. So it's just the amount that I decide that I want to set the fund up for. That's what I'm using, that amount. Now I have to go through the different expenses and code them to the correct accounts. So I have transportation in of $50. Well, because we're using perpetual inventory, that means that we want to put that cost towards the inventory. So remember I was telling you before that the cost of the material could include transportation and shipping, right? Depending. So we're going to debit inventory for $50. That's for the transportation and that's that shipping cost. Then we have the postage expense for $65. Miscellaneous expense, $120. So that's all debited because that's all my costs and my expenses. So those are debited. Then the $4 I'm short, so it's bad. So I'm going to have to debit. Okay, so I debit my account, cash short and over for $4. And then I'm going to credit cash for $239. Okay. Now, when I decide that I want to set up more money in that account, in that petty cash fund, I'm not going to have to write the check for the whole $525, right? Because I already have cash in that box of $491. I just need the difference. So my new amount is $525. My old amount is $490. So the difference is $35. So I'm going to cut a check out of my cash account in order to cash the check to get the cash to put in the petty cash box. Okay.
Okay, how did you get the 35 again?
So you take the $525 and deduct what we originally started with, which was the $490.
Oh.
So your petty cash fund has $490, and then you're always replenishing the cash that you spend. So you still go back to $490. Now I want $525, so I just take the difference. And then I put the $35 in the box. So now I don't have $490, I have $525. Okay. And it's the same entry as when you established the fund. Okay, so let's walk through a bank reconciliation. So we have this clinic that deposits all the cash receipts on the day when they are received, and it makes its cash payments by check. At the close of business on June 30th, its cash account shows $15,558 as a debit. That's good, right? We want our cash to have a debit balance. It means we have money in the bank. So the clinic on June 30th bank statement shows $14,544 on the deposit in the bank. All right, so we have outstanding checks of $1,652. June 30th bank statement lists a $65 service charge. Check number 919 listed with the canceled checks was correctly drawn for $789 in payment on the bill on June 15th. The clinic mistakenly recorded it with a debit to utilities expense and a credit to cash of $798. So you see the difference, right? It clears for $789. We mistakenly wrote it for $798. So we have an error. On June 30th, cash receipts of $2610 were placed in the bank night depository after bank hours and were not recorded on the June 30th bank statement. So they haven't received it yet because it's after 3. But I already recorded it because it tells me they're recording these deposits on the same day. So they brought it to the bank. It's not on the bank statement. So I have to know how to deal with these items. So we're going to start with our bank statement balance. They told us what the bank statement balance was. $14,544. So I think that you're going to have to select the titles. I don't know, has anybody done the homework yet? You're probably going to have a drop-down menu, I think, and select bank statement balance. Is it on there? Okay, good. Do they have anything that you have to select, or is it after add and less?
Right on their ad,
There's like the drop downs. Okay. So bank statement, you fill that amount in. Book balance, they give us that. It tells us $15,558. So we're going to just key that in. That's the information they gave us. Now we have to know, what do we do with these things that they just gave us? They listed these errors, deposits, outstanding. So now we need to know, what am I doing? Is it something that I just need to record on my bank side just to adjust the balance there? Or is it something that I actually have to do an adjusting entry in order to get it on my books? So the first one says outstanding checks of $1,652. So what did we decide that we have to do with outstanding checks? Did I already write them on my books? What's an outstanding check mean? It's an outstanding check that I wrote. So it's payables because I paid it out. And if I paid it out, it's already on my books. Outstanding means they haven't cleared the bank yet. So the bank's going to show I have that money, but I'm going to show I don't because I already deducted. So I'm going to have to make an adjustment on my bank side. So you see where it says deduct outstanding checks? I have to deduct that $1,652 from the bank statement because I have it on my books. So my balance is lower. And that's because they don't know I cut those checks yet. So I have to deduct them from the balance they're showing me. Make sense? Okay. Now it says on June 30th, the bank statement listed a $65 bank service charge. Maybe I didn't know about that service charge. So I haven't put it on my books yet. Now I have to do an adjusting entry. I have to do some sort of journal entry or something in the system to record that, so I can get it on my books that I had to pay $65. Because my balance, I never deducted that yet. So it's too high. So I have to do something. So if we look down here, I'm not sure. I think you're gonna have to finish that, then do the journal entry, but I want to show you right now. So On the first one, we don't do an entry because we've already recorded those checks. They just haven't cleared the bank yet. That's why we didn't do anything. For B, we have a miscellaneous expense, or it could be a service charge account, whatever they decide to call it at the organization. So it could be bank fees. We use bank fees for a lot of this kind of stuff. But they are deciding to use miscellaneous expense for the $65, and it's a debit because it's a fee that I had to pay, and I'm crediting my cash. So that way my balance that I'm showing, it doesn't include that money yet, so I got to deduct my money down. How do I do that in cash? I have to do a credit because my debit is my cash balance is a debit. So I have to credit cash with 65 to reduce it down, okay? So that's my entry. And then on my bank statement, I have to deduct this. So I'm deducting on the book balance side because I have to adjust that balance, right? Because it's not included in that. So I'm deducting the bank service charge of $65. So that's reducing that $15,558 that I had on the books. I'm reducing it down. All right, so now I have this error. So the bank has $789. I had that the check was $798. So what happened? I deducted too much out of my account, right, on the books. So my balance is too low by that $10 because I wrote it for more than what actually cleared the bank. So I got to do, well, it's not it's $9, not 10, sorry. So I have to add that back into my balance. So I'm adding my error on the check 919. I'm putting that $9 back on my books because when I wrote it, it was for too much. All right, so how do we have the journal entry for that one? So my cash is a debit for $9 because I reduced my cash by too much. So I got to put that difference back in there. So $9 is a debit to cash. It originally went to utilities expense when I wrote the check, and I wrote it for too much. So now my utilities expense is too high. So how do I reduce that? Well, an expense normally would have a debit. So since I have to reduce the expense, then I'm going to do a credit to utilities expense. I'm just going right back to the account that I originally had cut that check to. And the last one says that I had cash receipts of $26.10 that were placed in the bank's night depository, and it wasn't recorded on the bank statement. So if I had collected the money and made the deposit in the system, is that balance in my book balance? It is, because I already received the money and I already recorded it on my books and I brought it to the bank. Okay, the bank doesn't know that money has been deposited because it went in the night box. They'll get it the next morning. So since I already posted it on my books, because I received it on the 30th, so I put it in the bank on the 30th, in my, because I brought it that day. So that's when I posted that check. So I don't have to do anything on the books because I already put it on the books. It's already included in my balance because I already recorded it. But the bank doesn't know that that money's coming. It's not in that balance. So I have to add it into the balance that they gave me. So now my adjustment is to add on the bank side. I'm going to add that outstanding deposit. The deposit that went to the night drop, $26.10. So once I get all of the adjustments on the books, then I should balance. So I started with my bank of $15,544. I had to add the deposit in that the bank doesn't know I have yet until tomorrow, right? Because I just brought it late in the evening. So I'm adding that. And then I have to deduct the outstanding checks because I wrote some checks that they haven't received yet. So I got to deduct that from that balance. So I come up with $15,502. On my book side, I'm starting with $15,558. I need to add back the error of my check that I cut for the wrong amount, transpose my number. So I'm adding in the $9. And then I'm deducting that bank service charge that I didn't know about of $65. I have to do the journal entry to get it on my books. And so now my balance on my book side is 15,502. So you see how they should end up with the same balance. They should equal. So on the bank side, I'm not doing journal entries. I'm just noting what those are. And those scenario that they gave me, I got to note that. And do I need to adjust it? Do I need to go up or down? And I'm just adjusting that balance. I'm not actually doing any journal entries. But on the book side, when I have an adjustment, I have to do a journal entry. Okay, so you see D says no journal entry because those were deposits that I already put on my books that I brought late. Do y'all have any questions? This is just using our day sales uncollected. Same thing. This one is setting up your petty cash fund. You have some transactions that happen. So you're making those adjustments and doing the journal entries like we just did. There's just a couple more transactions in there that we did. And then regular questions, let's see. These are just regular questions too. All right, this is another petty cash. We did petty cash. Okay, so do y'all have any questions? Okay. Any questions on Zoom?
No, ma'am.
Okay,
No, I think I'm good too.
okay.